posterity's sake. Alrighty, recording is started. Today is August 22nd, already approaching the end of August. My name is Brian Wilson. I'm a market strategist at Market Structure Edge, and we're joined by Henry Howard today, who is our Director of Client Services. We're glad that you can join us here in late August. Tim Quast will be back with us next week. He's been in Italy enjoying a little bit of well-deserved time off. So we're going to kick it over to Henry to get things started. Henry, what's happening today?
Great. Thanks, Brian, and welcome everybody. Glad that you can join us again. I'm Henry. I'm the Director of Client Services. I write the desk note on Wednesdays, so you'll hear from me about every week. And then if you ever have questions or you write into the live chat, you'll be chatting with me. So feel free to shoot us some questions. Really quick, I'm just going to take, I feel redundant when I offer this, but I'm going to take everybody through our daily process. We have a number of new users, so I'm going to share my screen on our daily dashboard, and I'm going to walk you through my process on Edge. And it's just a handful of things that I go through that really drive my decision making from a data perspective, and then I'm going to wrap up with what I do for context. I tend to not share a whole lot about context. But for those of you who are new, this is Market Structure Edge. The first thing I'll do is I'll get in here to broad market sentiment. So I'm always really familiar with what broad market sentiment is doing. And again, if you look here, we have our green line here that is always our, we call that our entry point. It's just statistically when we get into this 4 range, we know that there's a really high likelihood that we're going to bounce off this green line and head higher. Similar, we're approaching 6. I look for 6.5, this red line. So that's my first read is knowing that broad market sentiment's continuing to rise, and so it's likely that there's if not positive momentum with the market, that we're actually going to, at a minimum right now, maintain the prices that we're at. We're seeing that play out over the last few days. So that's the first thing that I'm looking at is broad market sentiment. The second thing, as we've mentioned in the last few days, is we are flat on the short volumes. It is a bit of an anomaly, which I think Brian's going to talk about, for our market to be totally 50% short. So I think there's just some uncertainty. This tells me that there is some uncertainty in the market. This doesn't tell me that the market's necessarily going to fall apart or go backwards. It is just an indication of sort of the composition of the market and the attitude that that participants have. Is that it's an indication to me that there's a high degree of risk foreseen. I see this short volume thing as sort of one of two ways. If it gets covered, we can go higher. If it doesn't get covered, everybody is appropriately hedged. We've had these similar environments where we get to 50% hedged, and what happens is we actually, the hedges get sold off and get covered, and we actually push higher. But again, we're getting to this red line. We're nearing this red line at 5.8. We had this huge price move in SPY, so I'm seeing that that's already played out. So that's number one, is looking at broad market sentiment and short volume. The next thing that I look at is I peek over here. This is our momentum portfolio, 19 components. We rode for a while around like 8 components in our momentum portfolio. Yesterday, I think it was 20 and 21. But in this momentum portfolio, that's telling me how many of these companies are participating in this move. I'll jump into that portfolio later on to see what industry, what sector these names are part of. And then I'm looking at low volatility. Look at how there's been a significant move away from low volatility, so that even those names that tend to move just a little bit, there's been a move out of those and a move into some of our higher volatility names. So those are checking the number of components on both of those. And then the third thing I'll do is I'll move over here to big tech. Again, similar, sort of more pronounced to me than broad market short volume is this significant move higher in big tech. And so, before we had this run up, I'll hop into this big tech portfolio and show you some of the numbers in here. I might show you. I mentioned Google the other day, and I mentioned Microsoft, I think, a week ago. So the point being is, when we see these names like Google that, is down in the tranches of 1, is struggling to rise over 5, this is why we really don't recommend looking for that bounce off of 1, is because our nexus is 5. So I'm looking for a name that's getting over 5, that's moving higher, that has short volume, that's actually declining instead of what we saw in the last day Google having a little higher short volume. So I'll check these names. I like to see, I mentioned in my desk note on Monday that they're really moving together. So when I see these names start to move together, when I see these short volumes start to move together, that's a really good indication of that what we've seen already is a price move upwards, but you know watching Nvidia get to 54% and Meta get to 46 and Apple at 45%. I know if I pull up Apple, it's historically a bit lower on short volume here. So if this short volume was down in here, I'd have a little more confidence about this, our most recent move going forward. But this rising short and topping out at 10, it tells me that that this move may be short-lived. The other thing I'll peek at is what's the behavior? Who are the people who are driving the behavior in the market? Right now I see a lot of active investment. I think Brian might speak to some behaviors a little bit later. So that's sort of the third component that I'm looking at is, big tech being such a significant part of the market, a portion of market cap that really it's going to move. The market's going to move in tandem with big tech. So those are the first 3 things, and then what I'll do, a lot of our IBKR users, they only have access to daily trading ideas. I like to go in here and I like to look at first of all, what's up at 10, what has supply that's down, and I'll check those names. ILMN, I think we're all waiting for it to bounce off that off of its sort of price constraint, right at what was it at, right around 130. I think I'm waiting for it to jump here. So I'll check these names, and then what I'll do is I'll actually then go into our daily trading ideas. I like to sort by probability. I always like to find stuff that's moving up, and then I'll peek at how is this moving with tech. How is healthcare moving? So like if I find a name like VKTX, I'll actually go back to the dashboard and I'll take a peek at what's healthcare doing as a sector. So a lot of the because we have all this money in ETFs, that stuff is going to tend to move together. So it's moving similarly. What I'll see is healthcare. Yeah, we have healthcare. It's moving over 5. I like to see that. This declining short volume is a good thing to see for an individual name. And then all that sort of gets put into my perspective for making decisions. On occasion, I'll find a price level on a stock that I say, yeah, if this gets to that point, if it's down half its volatility, it's likely that I'll buy it, depending on the final portion of what I'm going to talk about is context. And all this data has to be filtered. The number 2 in Edge is context. And so last week had a ton of data. Obviously tomorrow we have a Fed, Jay Powell speaking. And so to me, those are risk events. So I'm taking all of this data and then I'm filtering it through what's the context, what are the risk events that are happening, or more specifically, what risk events are not happening. And I think that's as important. If there's nothing that's risky in the next 3 to 4 days, it tends to be that the market likes to rise, especially if we have that rising sentiment. So that's sort of an introduction to Market Structure Edge for those of you who are new. Feel free to drop your questions in the chat. I'm going to pop it back to Brian now, and he's going to give us a little more in-depth dive. And again, just let us know if you have any questions or if there's anything specific you want to ask.
Yeah, and I'll ask you one question, Henry, before I jump into a couple topics. It's obviously been a wild ride in the market, really, for the last 3 weeks or so. Can you talk to me about, your trading during this time frame? What have you been finding success in? Has it been difficult? What's been going on for your personal trading?
Yeah, I haven't added any long positions in 4 days. That ILMN, I do like that name, but seeing that the market's at 50% hedged, I'm still very I think there's a dual risk. There's just the inflation risk, the risk of holding cash right now, um, is a powerful sort of psychological force in my mind. And then the other one is that 50% short volume, that I don't think we're necessarily out of. That's telling me that we're not necessarily out of the woods. And I was going to talk about this earlier, but these volatility bounds that we provide. So I'll go back to sharing my screen. Especially in the momentum names. Um, when we provide these volatility, like I mentioned in my desk note on Wednesday that, for SPY, we're looking for 1%. So when SPY moves, 5%, or we see, tech as a whole bounce, 8% or 10%, the likelihood of that move continuing, and even the likelihood of that move statistically staying, is really, it's not very, like, it's not a high probability. Getting long after that sort of move isn't a high volatility play. So I have one thing that a couple weeks ago I added. I had mentioned Disney, that I added to more of a, my longer term portfolio. But as far as trading, I'm just looking at these volatility boundaries. um, you know from my perspective, it's a sell, buy the dip, sell the rip. But we're obviously seeing that, like, there's some context to tomorrow and the Jay Powell announcement that's sort of giving me pause to get, to commit too much capital anywhere at this moment in time. So I was a little bit of
Yeah,
a convoluted answer, but that's the fact. Is, I don't have a huge commitment one way or another, because there's nothing striking me um, as an excellent move right now. So it's a little bit of a preservation of a capital, um, if anything else, right now.
sure, sure. Those were good points. I'm going to dig into the weeds just a little bit with a couple of items with you guys today. Part of it I'm calling the outliers in the data. And I mentioned this in the market desk note this morning. Henry hinted at it already for one of the items. We'll start with short volume, and you can see it right away. Once again, for those that are new, this is market structure sentiment here in green. SPY is this top one, and short volumes are right here. So short volumes have stayed at 50% for over 2 weeks running. And you can run this look backwards a little bit. Let's run it back a year and just show you what pops up in the data. The longer you run it back, everything gets a little bit more crowded together. But you can see just a couple of episodes during the last year. Short volume was here at 50% for 2 or 3 days, 2 or 3 days here. And really, when you look back, maybe a little stretch there, right around 51%. But generally speaking, this is an outlier. This is an anomaly. If you take it back 3 years, once again, this is going to become a little bit harder to read. But the same trend plays through. You just don't see that sideways movement from a short volume perspective. So we're in the midst of an outlier right now with short volume. In some respects, and you can see it happening right in here. So when the market looked like it was going to tip over, short volumes were right at 50%. In some respects, I think market participants were playing the market long, that the market was going to go up, but they were protecting the other side of that trade. That's speculation on my part, but we're just looking at the data and we're looking at what's been happening in the market. To me, that part of the trade, makes a little bit of sense. So that's one outlier. And as I mentioned in the note today, whenever you have outliers in the data, it just makes it very difficult in terms of positioning. And an outlier is an outlier for a reason. It makes predictive quality just a little bit challenging. Let me show you the next outlier. This one is in the only ETF that is in our system. We don't put a lot of ETFs, or we don't put ETFs in the system because a lot of that activity is on the risk management side, and it tends to convolute the data. What I want to show you right here is SPY rising to 10. Once again, that's an outlier. It just does not happen very often. Let me take you back to a couple of data points. These are not reports that you will see. It's over at our sister company, but I just wanted to share them with you. This is 2022, a little bit of a bear market. Surprisingly, but perhaps it wasn't surprising, the market was a little bit more volatile. This is SPY sentiment. We were hitting 10 a little bit more often during a bear market. Let's fast forward, and we're looking at 2023. So bull market moving higher over time. During that whole time, guess what? We only hit 10 one time the entire year. And I'll go in and show you the details on a couple of these here in just a second. This year, what does SPY sentiment look like? Well, it's neutral most of the time. We just had that dip about a week ago, and there we are, moving up to 10. This, I believe, is the 2023, and you can see it hitting 10. Momentum briefly slowed down, and then we went higher after that. I'm not saying the same thing will happen this time, but the point is we just don't have too many data points to share with you in regards to SPY. Once again, it's an outlier. Just know that with sentiment hitting 10 right now, we're hitting those bounds once again from a volatility perspective. And that's the next point that I want to share with you, is actually on the volatility side. And once again, this is our sister company, Modern IR. I just like the report that comes out for this particular report. So S&P 500, what I want to show you is intraday volatility trends, the norms, and this is a representation of underlying stocks, S&P 500 stocks. Norms are 2.1% for underlying stocks. This number, the last 5 days, is 1.7. That number 2 weeks ago was 3.6. So think about it as a pendulum that is swinging, and we go way too far one direction, which was that 3.6, and we've gone back hard the other way, but we've moved outside the bounds of normal volatility. I wrote about it this morning in today's note that I expected a volatility surge at some point, basically because of this. Markets tend to mean revert over time. That pendulum has swung too far the other direction. It doesn't surprise me that we're getting a little bit of volatility. It's very hard to predict exactly when it's going to happen, but that fact that we are getting some volatility is really not a surprise. So that's the outliers. Once again, outliers in terms of short volume, the SPY sentiment, and intraday volatility. You add it up, and it equals a dicey market. It equals a market that's just difficult to predict right now. I did want to go over to the daily trading ideas for a moment, and just to talk through part of this. Henry talked through part of his process. My process usually when I'm looking at these names, and if you see me, and I mentioned a few names this morning, if I mention names, what I will usually do, and I'll give you an example, momentum portfolio, I will screen them by probability. It's just the way that I like to do it. And for instance, today, I was looking at the names, I believe 80%, 80% going down to 100%. So I'll look at, and I won't go through these right now, but I'll look at the demand supply setup for those names and then just pick out the ones that I like. But once again, when you're talking about these opportunities, we're looking for entry lows and entry highs. We're looking at picking up names somewhere in this area. And I wanted to circle back for a moment just to talk about the actual probabilities that are inherent here. Tim wrote a note. This is actually going back to May. And I just wanted to share part of this note with you. This was in a market desk note, I believe it was May 20th. The part that I wanted to share with you had to do with, well, let's start here because I think this is important. When you're looking at daily ideas, when are they, or when might they be difficult to actually produce a return? Well, if you buy positions during options expirations, that can be challenging. If you buy a position during the middle of earnings, that can be challenging as well. You have to pay attention to the math. If you get into a name and the demand supply setup changes in that name, well, it might be time to exit that particular position, and then having downside protection in place is important. So when you incorporate these elements, making sure that you have, risk management components taken care of. What I will generally do with my momentum names, I will set a stop loss. It's usually about 2.5% lower. So just giving a little bit of room for that stock to move. Remember, the momentum names will tend to move more. If I set a really tight stop limit, I'm going to be, stopped out of those names a little bit more often than I want to be. Low volatility, I'll usually set that about 1.5% lower. But if we look at the actual percentages here, number 2 in Tim's note, about 55% of the time, those stocks in momentum or low volatility, they'll give you an entry in the recommended range. Once again, that low range and that high range. Those positions will produce gains of 68% of the time, stop outs 32% of the time. This number, I think, would actually be a little bit lower right now. When Tim wrote this, we were using 1% stop outs. We've kind of changed our philosophy just a little bit. But the point here is look at the actual returns. The gains are much better than the losses over the trailing year back from about May 1st, 2024, the model averaged 1.2% daily gain, average holding period of 1.1 days, and about 223 trading days. So in other words, incorporating this model, producing gains 68% of the time, averaging 1%, a little over 1% a day. Yeah, I mean, you can do the math, that's well over, 225%. For a course of a trading year. Will any of us do this perfectly? Of course not. But the point is that there's opportunity here, and it's been statistically proven over time. You just want to make sure that your parameters are set up to avoid some of the hiccups that can turn a stop loss 1.5% lower, and suddenly you're sitting on a 10% loss, and that just eats away at your returns. So I did want to talk about those daily trading ideas. The math is there. They're very, very good. It's a good reminder for myself that I actually need to trade more. I don't trade enough in these ideas. Once again, the math is there. I need to take advantage of that and just be present. I'm human, just like you are. When I lose money in a trade, you can sometimes get emotionally attached to that. But I need to remember, what the statistics actually bear out over time. So that being said, what have I been making money on recently? And perhaps it tells us what's happening in the market right now. I've actually been making money on the low volatility side. I've I've not been making money on the momentum side. So low volatility has had fewer choices. That's where I've been doing a little bit better. And ironically enough, a couple of days ago, I made money on a volatility trade where I thought the market would become more volatile. Why did I place that trade? Once again, circling back to this, I saw intraday volatility where that pendulum had swung too far one way, and I figured volatility would get reintroduced into the market at some point. So that's some of the outliers in the data, daily trading ideas, recent winning trades. Let's circle back for a moment to where we are right now, and we'll kind of paint a picture of, what we're looking at as we look ahead. So Henry had mentioned this earlier. We're approaching the red line. Now, the red line doesn't mean that the market is going to blow up. And in fact, let me share a spreadsheet. I won't spend a lot of time on this, but I think it's helpful to know what happens when you do reach that red line. So this is data actually going back to 2020, and I'll just briefly walk you through the way that I oriented this spreadsheet. I made a note when SPY moved above 6. I made a note when it moved below 6, took mention of the number of trading days, and what was the percentage when it was above 6, during that time frame. What happened 2 weeks afterwards? So that's what you're seeing here on this spreadsheet, basically just looking at what happens when the market is above 6, and then what happens afterwards. And 2020, and the data goes all the way through 2023. And I've picked up a couple of episodes in 2024. And I need to update this spreadsheet. We've had a couple of more instances where we've moved above 6. Here's the bottom line. If you look at a period that is a little over 4 years in duration, what happens when the market is above 6? Returns of 60 basis points. Now that includes, bear markets, that includes bull markets, that included the bear market of 2022. If you look at what was happening during 2022, that's where most of the red is. If you're in a bull market and you're above 6, it's just a volatile market. It's going to be difficult to post gains. If you're in a bullish market, here's us getting out of 2022. What do we see? We see a lot of green. You look at returns during 2023. What do we see? We see a lot of green. But, once again, looking at that from a 4-year average, 60 basis points, above the red line. What does it look like for the 2 weeks afterwards? When we break down from that red line, does the market fall apart? No, not really. If we look at it from a 4-year average, that average is 40 basis points. It's worse in a bear market. That was declines of 70 basis points. Better in a bull market, returns of 1.5%. So I just wanted to give you an idea. We're approaching that red line. What does that actually mean? It tends to mean that gains slow down, but the market doesn't tend to blow up. And it is different, of course, bear versus bull. Here's a thought for those that like to, play in the options market. And let's just look at 2023 as an example. So these were, once again, returns above the red line during a bull market, 2.2%, 1.6, 1.4, 3.6. You get the idea that the market doesn't extend too much further. This was the one outlier moving 3.6% higher. Here's a thought. Sell a call contract. Sell a call contract on the SPY, knowing that we're probably not going to move much higher from the levels that we're at right now. You could put a call contract out, 4% higher. market's probably not going to get there. Once again, these are central tendencies. Could it get there? Absolutely. But, data bears out the fact over time that we don't tend to move much higher from a broad market perspective. So that's part of what I wanted to share with you, just the fact that we're approaching the red line. Also coming up next, which will be next week, will be month-end activity. And then what happens here? Henry mentioned this already. Do shorts get covered? Do shorts move higher? We're just at an extreme outlier, at this particular time. So we'll just have to see what is happening there. Let me stop sharing my screen for a moment. Do we have any questions to catch up on, Henry? And you're muted right now, Henry.
Sorry, Brian. We had one question about DD DuPont. It's in low volatility in the daily trading ideas, and sort of just having someone having you go over what it looks like for calls. You had mentioned, putting a call, this person asking about the August 30 calls, and applying the data to options. So do you want to take that, or?
Yeah, we can take a look at DD August 30th calls. Okay, let's go take a quick look. All right, so DuPont right now trading at $80. I mean, you can see right away that, this is not a very liquid. You look at the volume just today, 13 contracts, 3 contracts, and, that's really not very far away. It's trading at $80 and, $81. It's not very far away. So right away, I would be somewhat hesitant trading a name like DuPont, just because it's not very liquid. If you look at, well, let's before I go somewhere else, let's take a peek at DuPont in terms of the actual info in Edge. And I'll circle back to the point I was going to make. If you look at the setup right now, it's a great setup from a supply-demand perspective. I was looking at this name shortly before the call, certainly going to possibly consider, buying the name towards the close today. But sentiment is right at 5. You can see this tends to be a name that hovers, right around neutral. You'll have some of those, brief moves higher. Short volumes are lower. It's a low volatility name, so you don't tend to get huge moves in price. If you're looking at it from a call contract going out to next week, for it to get to 82 might be a little bit of a stretch, just because it is a low volatility play. This would probably be a better bet if you're actually, looking at trading. But once again, it just doesn't trade very much from an options perspective. If you look at a name, let's take Tesla, for example, and it's trading at 214 right now, and you look at the number of contracts, 32,000 contracts. So what I will do a lot of times if I'm playing in the options market is I will keep track, and I'll just show you my portfolio. These are the 2 names that I own right now, by the way, Honeywell and DTE. I'll keep track of the top 15 names in the market, Microsoft going down through whatever that is, XOM, Tesla. I'll keep track of those because I know they're so liquid. So I'll look at them on a daily basis. And if something gets out of its volatility bounds, that's when I'll pay a little bit more attention from an options perspective. For instance, I was looking at Tesla earlier, this is outside of its normal volatility bounds. Now, there is news in the name today that might warrant the fact that it's lower like that. And what do I mean by outside of its normal bounds? If you look at Tesla, and we'll pull it up here in big tech.
So while you're pulling that up, Brian,
Yeah,
I'll share. Um, I think the question is about volatility and entry points, and so
yeah,
you know, I'd agree. Like for DuPont in this example that we pulled up, I want to just mention one thing. What's driving the fact that this is all algorithmic, and the reason DuPont's showing up in this portfolio is because it has falling supply, right? So
right,
as its short volumes falling, when you look at this after you realize it's populated the portfolio, is that it's bounced off of here. So we can kind of look back. It's obviously a low volatility. It hangs at 5. Um, what we're really looking for in this is that it's a high probability that if it sells off its volatility or even half its volatility, it's likely not going to stay down there. It's going to bounce. And so we had 2 questions regarding volatility and entry points. And depending on what the volatility of the market is doing, sometimes and my own confidence as a trader it's a lot of times it's half the volatility. So in a situation like this, if you see it's down half its volatility, you can sort of churn that trade out, knowing that if it has declining short volume, that it's likely going to rise from that point, and that's a good entry point. I think a lot on these lower volatility trades, the entry point is, if not, it's probably the most important is getting that good entry point, because it's not just going to take off. Obviously on these lower volatility, you suffer from some time decay on the options. But that's what I would be waiting for is until it reaches that lower entry point, and once it's down half of its volatility, that's the point at which we'll approach it. So I hope that
right.
gives good perspective if you want to share your Tesla look.
Yeah, yes, thank you. And I think I realized I was not sharing my screen earlier, so I apologize for that. I think I did that last week as well. Get back to screen sharing and the Tesla example, and I can circle back to DuPont real quickly as well and share what I was actually talking about. Here's Tesla right now, intraday volatility of 4%. And if you look at it, it's a really good setup. We see sentiment that is rising sharply, short volumes that are lower. Now, if this and right now, Tesla, as we're speaking, where are you, Tesla? Down 4.2%. So it's down all of its volatility on the day. This is actually one that, maybe if it moves down more during, later in the day, I might buy a call contract in this one. Once again, if I'm playing in the options market, I'd like it to be a little bit more, um, a little bit greater accessibility for those contracts, a little bit more liquid. And I find a lot of these in the top 15 names tend to be very, very liquid. Circling back to DuPont, once again, I apologize because I messed that up earlier. But if you look at the difference between Tesla, look at the open contracts right now. 32,000 contracts have traded so far today, and look at the difference with DuPont. So far today, 3 contracts have traded. So you can have the best name in the world, but if it's not very liquid, it can be really challenging to get in and out of that name. So that would just be a recommendation in terms of the options market. Just consider liquidity, because I've had many a trade where it was a really good setup, but the name just wasn't liquid enough. Henry, any other questions coming in?
No, I think we'll just open the floor if there's anything anybody wants to ask.
And we'll end it here in just a moment. I'll just share one other item before we take off. Just a consideration here going into month end. And we talked about this with the spreadsheet that I shared. But once again, just think about where we are from a market perspective. There's been incredible price moves here during the last 2.5 weeks or so. We're at an outlier in terms of short volume. It appears that there's been just a I'll call it a weird hedge. There's been a hedge in the market. We are approaching the red line. Once again, that tends to mean that gains will slow down here over the coming week or so. It doesn't mean that the market's about to implode, but just be aware that it does tend to slow down appreciation. There's different ways, that you can approach that, if you're interested in trading that. Happy to unpack any of these concepts with you guys at any time. Henry and I both can be reached via email. Tim can be as well. And let's see, Michael, you mentioned a question on Tesla. Tesla's outside its normal volatility. How do you see this difference? I'm not sure if I understand the question about difference, but today I see it being outside of its volatility, but there is a story out there right now in regards to Tesla. So I think that's part of the reason why it's outside of its normal volatility range. Hopefully that's what you were talking about, Michael.
Yeah, Michael, for those of you who are just on IBKR, our IBKR users can't see daily volatility on every stock. So this is, again, my big tech portfolio on the dashboard. So here we have volatility for every stock. So, what we're saying is outside of its 4% volatility, that we know that that's what we can expect from Tesla to move in any given day. So when it moves outside of that, we know that there's likely some sort of news or something else that's happening, something abnormal, or it's, sometimes whether or not it's tradable is a question, but that's where we get that number from.
And Forrest, looks like you have a question.
Yeah, and we can take this offline if you want. I want to look at the demand that's below 5, with a supply that's declining. So let's say I want to group them like demand 2 to 3 or 1 to 5, and demand that's falling. Is there a way that I can query that? And I just don't know how to do it.
Sure. If you stick around, after this is over, I'll stop the recording and we can talk about that for a minute. Yeah.
Thanks.
Yeah, absolutely. Anything else that we can address today? If not, thank you for joining us today. We really appreciate it. We'll be back next week. Tim will be back in the saddle come Monday morning with the market desk notes. Our normal cadence, by the way, is Tim usually has Monday and Tuesdays. Henry's usually on Wednesday, and I usually have Thursdays and Fridays. So if it's a normal week and we're not traveling, that's what you'll typically see. So with that, we will stop the recording and wish you all just a wonderful